Hey, welcome to our podcast today, BYOB Square, where we talk about becoming your own banker and we talk about having a beverage and sharing. Cheers.
Amen.
Today we're going to be talking about a really important subject right now with all the interest rate conversations, inflation, all the things that are happening in 2023. Most people thinking there's a recession coming. We go back to basics when we have this volatility, at least in our framework, which is, okay, let's look inside the house, not outside the house. What's happening with our money? So today we're going to be talking about how the average American tends to spend money, comes from income, and all expenses go out. And the premise we're going to talk about is aligning that expense pattern with your values, with what's important to you, with the people you love, is probably going to bring a lot of abundance, especially if you do it efficiently by using assets that purchase those expenses. So we're going to be talking about that today. Quick conversation here. As always, our podcast features a business in our community because we are focused on making our communities better by supporting small businesses. So I'll let you introduce this one, Josh.
Thanks, David. So the Well Chiropractic is our featured business for this episode. They've got two locations in the East Valley, one in the North Central Gilbert area and one in East Mesa. I've been using them for about a year now. They helped me with a pretty serious back issue, like half my back and my right arm was like immobilized, is what it felt like. And they got me back on the right track and have been great to work with, great service. Always feel like I'm appreciated when I walk in the door. So awesome. I definitely recommend the Well Chiropractic if you need that kind of work on your body, because you need a good body in order to have a good business, a good life.
Yep.
You know, everything works together in order to further us forward. So definitely give them a try if you're looking for a great chiropractic.
Perfect. Awesome. The other thing I wanted to touch quickly on was, hey, let's talk about how we connect the conversation we had last on episode 5 with what we're talking about today. And there are two main ideas that we talked about last time. Traditional financial planning is failing. And the two ideas that we proposed of why that typical financial is failing is the following. Number one is we're not understanding how money works because we're not understanding the roles we're playing in that economy. And most people do not understand that their need for finance is probably one of the greatest needs they'll have in their lifetime. And number two, if that's the greatest need that they're having, who are they financing through? In other words, are you using someone else's bank? Are you using somebody else's entity or pool of money to finance everything you buy? And what's the cost associated to that? When we talk about that, we talk about money moves. And most people think about money moving in two ways, either financing or using debt, a credit card, or using cash. And whether you're using cash, accumulating cash over time, and then making purchases when you have that amount safe, or you're using a credit card or debt to draw a balance and then make repayments over time, both strategies lead to always going back to zero and restarting the process, interrupting compounding in your capital and your money. So the idea that we understand that debt and cash are two opposite sides of the same coin is important because then it allows us to think at a higher plane, which is, okay, how could I set myself up to take advantage of the best features for both strategies, right? Cash is important because it's discipline, accumulates capital, but then I don't want to interrupt the compounding at the same time that I also have access to my money so I can go deploy it to pay for expenses, buy assets, even recapture liabilities, right? So that answer is here. How could we create a process where we can constantly compound at the same time we have access money? The second idea, Josh, I love when you talk about this because it's very true to your life and to your experience as an investor. But is the focus in nest egg versus cash flow? So what are your thoughts there?
Right. So traditional financial planning tells us to put money away during our working years in order to accumulate a nest egg that's going to keep growing 6% on average, using a 4% withdrawal rate. You know, if you max out your 401k in this instance over the next 30 years of work, by the time you hit age 65, you'll have a nest egg somewhere around $2.5 to $3 million. You withdraw 4% of that a year, but it's still going up at 6%. So it's still, kind of keeping up with inflation. But best case scenario, if you're living off a 4% withdrawal rate of $2.5 million valuation, that's $100,000 a year, 30 years from now. And if we look at $100,000 30 years ago versus today, you're not really getting set up for success in that example. Not to belittle 401ks, if you've got one, congratulations for putting money away for your future. That's a great thing. And how can we take advantage of better opportunities or shift a little bit of those funds? So that's where we look at cash flow instead of sending money into this plan that we can't touch for the next 30 plus years. Can we buy income producing assets such as real estate instead? Have a tenant pay down that mortgage over the next 30 years.
Yeah.
Have depreciation on our taxes. Have appreciation in property value. Get that passive income to either refuel the system or to help support our lifestyle today. And then, in the future, when those mortgages are paid off, well, now I've got a paid off asset that's giving me cash flow, and it's still going up in value. So it's a little bit, different curve, a little bit different understanding. And in the pro formas that I've put together, you're looking at least 10 times the cash flow.
Yeah.
If you were to take the same monies and put them into real estate.
Yeah. I love what you said. It's not that we're belittling any strategy. As a matter of fact, what we are actually saying, to be very accurate, is we're inviting you to do what Nelson said in his fifth rule of the rules of banking. Rethink your thinking. Mm-hmm. If you look at these two frameworks, are they serving you well? Are they producing the outcomes you want? Are they building the life that you want? And to me, the concern is that if we all continue on this model, how do we continue to explain that 70 million plus baby boomers have the number one concern to be that they're going to run out of money in retirement, right? If this model is not working for them now, how do we continue to do the same thing and not have that concern? So to me, rethinking the thinking and focusing on, okay, is there a new structure that could bring more well-being, more abundance to my life available? And if you see it, like we've seen something different for us, definitely educate yourself and put it into action. So that's a quick recap of what we talked about last week. And today we're just going to get into the meat. We have some supporting information here. The detail and the numbers probably is less important than the actual idea that we're trying to present here, which is, again, if you are aligned in values and how you deploy money, you'll probably find more efficient ways to create more money with your money, because you're going to be in a journey of abundance versus having no control and no awareness of where your money is going, or having that money go in places where it's not leading to the life you want to build. So let's talk about some of this data, and we can take it fast, slow, however you think, but let's try to draw from all these charts and all that the most insight we can share for people to rethink their thinking.
Absolutely. So this data is pulled directly from the Bureau of Labor Statistics, their 2022 study. They looked at the average household earnings, expenditures, and if you actually look at the true report, they are so specific in each subsection of these subsections. Yeah. And it's really fascinating the level of detail that's provided. So looking at this, the average household is bringing in a little over $87,000 a year gross. So that's before taxes. After tax, that's a little bit closer to about $79,000. Mm-hmm. And then expenditures are making up about 85% of their whole income. So after all these expenditures, they're left over with 15% that is, fund money, is savings, is investments, things like that. And we want to focus on just highlighting that at this point, because if we can somehow shift the household expenditures or take better advantage of financing those opportunities and becoming the bank in those opportunities, well, now we're controlling more than just the 15% that's left over. Yeah. And one of the biggest items within that is the cost of housing, 29 to 30% on average. Transportation, vehicles, vehicle expenses about 14%, and then 10% is going to food, which is probably low in my household. Probably, I feel like we're a bit higher than that.
And it depends on the size of family and what stage you're in life and all that. So these numbers will be, again, an average for averaging different groups of families. You will talk about that in a little bit, whether you're in later stages and you have grandkids or you're just starting a family, this will have variation. But in general, I love what you said there. If our after-tax income is $78,000, 85% likely of that money will go outside of your household to pay for either transportation or living expenses, boats, cars, transportation, food, healthcare, all kinds of things that are included, itemized in this list. The part that I think is interesting is that out of that 15%, it's difficult to make the assumption that that all will go into savings.
Right.
Because most people don't operate from the sense that, hey, I need to create cash flow. So the difference between my income and my expenses is valuable money that I need to go and use and buy assets. It will become fun money.
Right.
It will become discretional spending, all the names that we have for this thing. And the savings rate in reality, which we're going to talk about, will be less than what you would assume looking at this data. So that's a significant challenge there.
Right. And we'll get to that data here. So if 15% is left over, how much do you think is going to savings? And that's actually closer to 3% on average is going to savings.
Yeah.
And that'll be on our next slide where we get into the true breakdown.
Yeah, we have some
a little bit nitty gritty there. But we wanted to look here at the percentage in blue, the percentage of monthly expenses of our income. So again, transportation about 20%, housing 30%, cost of living about 40%, and that leaves us with 10 to 15% left over,
which is
in the savings.
Which is consistent. This data comes actually from Becoming Your Own Banker. It's a chart that Nelson included in the early 2000s. I thought it was interesting that the percentages of expenditures and income in 2021 match what he was talking about 20 years ago.
Right.
So that's why we're putting this here. But I'll let you go because I think you're going to now the efficiency within that spending percentage.
Correct. So yeah, it is interesting how over 20 years these percentages have not shifted that much. And red here shows of these different payments, how much is going towards paying the interest in these different environments. So in transportation, 20% of that payment is going to pay for interest. So if we had a $500, as I mess everything up here, David.
Nope.
So if we had a $500 vehicle payment, 20% of that, $100 is going to interest.
Yeah.
In housing, and this is at about a 6.5% interest rate or so. Let's say we had a $1,000 principal and interest payment for housing. About 85% of that, or $850, is going to interest. Now, that's in year one. Obviously, as the principal balance of that mortgage gets paid down, it becomes a more efficient system. There's less money going to interest. But we want to point this out because this is the biggest area of opportunity for recovering the cost of interest. And how can we utilize the infinite banking concept from Nelson Nash in order to recoup some of that interest? And I want to point out too, don't let this scare you from owning a home, because the true cost of renting is 100% of that payment is interest.
Right.
You're not paying down any principal. You're not getting any appreciation of the home. So yes, it is a lot of interest, and it's still better than the alternative.
Yeah.
When we look at cost of living, about 20% of that cost is going to interest. That 20% is probably carrying a balance on a credit card, or an emergency expense came up, that kind of
Financing a boat, giving up interest when you use cash to pay for experiences.
So this isn't the interest rate, it is the percentage of the payment towards these that is making up interest. So we want to point that out specifically for housing, because it's the biggest area of opportunity to shift our thinking of finance and to shift our practices to implement the infinite banking concept.
This chart made a huge impact on me when I read the book, to be honest with you, because it shifted my awareness of what was happening when I was, earning income, paying expenses, putting money away in a retirement account, and thinking that I was doing the right things, yet not feeling that my lifestyle was improving as I got more disciplined.
Right.
And the one thing I like to point out is, again, the red is just a conversation about volume of interest. Out of as much as you're paying in transportation, how much of a percentage of that total payment that's leaving you goes to somebody else in the form of interest or interest that you're giving up in the use of cash? The traditional planning will tell you that if you maximize your savings, you save as much as you can, and then we try to increase the return on those savings, you'll be okay in retirement. And it's all a conversation about this side of the equation, which could be 15% if we look at the numbers from the Bureau.
Right.
But in reality, it's more like 5 or 10%. Or, what now I learned and discovered that shift in my mind is like, okay, what if we just take a look at the whole pattern, right? And we say, would I be better off just by starting by reducing the inefficiencies and everything that I'm doing with my money and adding that cash flow now to my savings and deploying those savings in things that I actually understand, that I have more control and certainty, like real estate.
Sure.
So this, again, for your awareness, the first one is how much money as volume of money that you receive in income is likely leaving the average American. And we said that is probably 85% and probably more. And then the other part of this is within that 85%, a lot of the volume of that money is living in the form of interest. So what if you had the ability to reduce the amount of interest you paid and use that to move to the savings column? The next set of data here that we were looking at, we thought was interesting, was savings rate versus disposable personal income from the Fed side, from the Federal Reserve side of St. Louis. So a couple things that I wanted to point out, and I'll let you comment on this, but I thought we got a chuckle on this. The blue line represents the personal savings rate in the U.S., okay? And as of 2022, December, that's 3.4. And then you see, no worries, this board is acting up. But as of December 22, it's 3.4% based on what the Fed has in their statistics. And you see a couple peaks here in May or right before May on 2020 during COVID, above 30%. And then you see a couple other peaks in January and May of 2021. And those correspond in the timeline to when the periods of time where people receive stimulus checks.
Right.
So the infusion of more money into the economy, particularly into the households, created these spikes where people just perceive their personal rate to increase. And as those paychecks went away, the savings rate went down, and then you see those impulses. So I think that was really interesting. More importantly, which you're going to talk about, is this red line, because this red line tells me more truth about what this really represented.
Sure. The red line is the real disposable income. So as we see these peaks, we see that the disposable income increases. Obviously, you're getting a stimulus check. You have more money that is not part of your typical income, therefore it's disposable. But what we see is, that spikes, but then it comes down almost 5% in this first one, negative 5%. So what happened there is people got, let's say, $1,000 stimulus check, but they went and spent $1,050. So they're spending more than they truly have to be disposable, and then that's putting them into debt. So the best practice would have been, okay, let's use that money and either pay off some high interest debt or invest it. But instead we see that this free money has created more debt in society. So yes, we got that brand new TV, but we're still paying for it. It wasn't free because we incurred some additional cost because we spent more than we truly had the ability to spend. And we see that with each time that those stimulus checks came out. The biggest one being almost 15% negative. So again, you get that $1,000 check, you spent $1,000 and like $500, almost like $1,200 instead of the $1,000. So you're overspending, you're incurring debt, and then that puts you in a forced reduction of savings thereafter because you're trying to pay off that balance. So that's why this the blue line increases and then is a steady decline. If we were to flatten out this curve and look at the true trajectory, since the first stimulus, the savings rate is at a pretty consistent decline because people were overspending and then having to pay the interest cost of those credit cards in order to get out of the hole. And also, the unemployment, the businesses closing, everything else that happened with the COVID response, which we're not going to get on a political soapbox, there were plenty of economic factors that are also influencing the savings rate. Obviously, cost of living. If you can't work, if you can't go to your small business because it's been forcibly shut down, obviously your savings rate is going to decline. And it's interesting how it also parallels the stimulus checks.
Yeah. Yeah, and this red line is actually a real curve, so it's adjusted for inflation. So it's interesting to see that savings rate declines over time as we see the effects of increasing the money supply. People are experiencing the effects of inflation with increased prices. So what happens? You have your income that has not increased significantly compared to how prices have increased. Your savings rate is just going to continue to suffer. So all that to say that when we see that in 2021, perceived expenditures are 85% of after-tax dollars, the reality that people are experiencing is probably much less favorable than 15% in savings rate, and it's probably under 5. So a lot of inefficiency in how we're spending our money. We're spending our money in a lot of living expenses, and our savings rate continue to suffer through the effects of inflation, which invites us to think, hey, we need to be really, really thoughtful about how we spend money and where we spend that, and where we save money to create more efficiencies. The last thing I think we were going to talk about today, which I think it's more for awareness and geekiness, because I think this is definitely a chart to pick up the brain of us geeks on what we see, right? So we talked about spending patterns. We talked about the effects of interest costs in those spending patterns. We've talked about the actual trend that we observe in savings rate today. The last thing is, hey, that savings rate, that inflation, all those conditions in the environment do not affect you equally depending on the stage of life you're in. So I found this chart on Twitter and I thought it was fascinating. A ton of people were retweeting this and commenting about it. But what caught my eye was how to think about spending patterns based on your generation. So we have here a chart with five of the current generations, and we'll make sure to put that close in the video so you can take a look at the details. But we have the silent generation, people born between 1945, boomers, Generation X, millennials, and then the Gen Zs. And it's fascinating to look through this pattern. So we can go back and forth pointing things out. There's no really a specific way we wanted to go about this, but for me, some things that jump in that we talked about is how income peaks at a certain stage of your life. So when you zoom in into this, you'll see that the silent generation average annual expenditure, which probably correlates to their income as well, is around $44,000. Increases for boomers to 62, peaks for Generation Xers at 83, and then it rolls over again, 69 for millennials and 41 for Gen Z. So this is the expenditure pattern they have. And in this time of your life, between your 40s and 60s, you're going to have peak expending, which makes sense, right? You're going to have family, you're going to be, probably owning a business, creating the most income you've ever created.
Right.
So this was really interesting to me. And then regardless of that spending pattern, housing is the top expenditure that any generation will spend, will experience, regardless of their point of life. So very interesting that you talked about the largest amount of volume of interest being spent on that category, and yet is the largest spent outside of taxes that the households will experience.
Absolutely. The biggest fascinating points to me were looking at where I am. So I'm in the millennial category.
Right. And
being able to look at the other age brackets in order to see how should I be planning for the future. So looking at things like healthcare, well, I can expect my healthcare costs to almost double in the next 40 years. So how do I plan ahead for that? How do I make sure that in 40 years I have the funds to support my aging body and the different needs I'm going to have there? Looking at other things like cost of education, which I'm trying to find on here again. So cost of education, I highly doubt there's a 40 to 60-year-old who's going to college, and yet the cost of education is incredibly high. Well, why is that? Well, they're paying for their Gen Zs to be going to college. So looking at that kind of thing of, okay, this is the average, how do I plan on that for my own kids, my household? How do I set up my kids that are going to be in generation, I don't even know what the current one is, but how do I help set them up for success as well in order to overcome the cost of housing, the cost of transportation, and these other things. So looking at the kind of bracket by bracket, one can help us predict where our money will need to go in the future, help us understand how to plan ahead for it, and then also provide some level of education for our children and the next generation of how they can also be equipped. Yeah. Because it's not just about us, it's about training our kids for legacy and helping them being the best members of society that they could be. And how can we do that? Well, if they have the best financial future possible, then they're able to be a better functioning member of society, enact more change in society, build bigger businesses, all this kind of thing. So the generational understanding, to me, is the most powerful impact of this chart.
We'll make sure to put a link to this chart on the notes below this video for you to go and take a look at it. But I thought it was very, very important to recognize that there's nuance in this conversation. It's just not about the general average person, but where you are actually with respect to time in your life. What stage are you? Are you preparing for kids? Are you in the middle of the journey? Are you now looking at what your retirement or your passive income stage? Regardless of where you are, there's no doubt in my mind that controlling a larger, ever-increasing pool of money, a pool of money that you can continue to control and grow, is always going to be in the direction of more abundance, better quality of life, and probably creating intentionally the circumstances you want around you. So I hope this has been helpful. And again, our objective is to help you rethink your thinking. We don't try to promote that we have ownership of the truth, but this is our experience, and this is how we have set up a framework for managing our business and our families. And hopefully it helps you also decide whether what you're doing is serving you or not, or if there's an opportunity to improve. So thank you, Josh. Great conversation today.
Thank you, David. And we'll see you all on the next episode.